Hi, this is Susie Spicer. Today I want to talk to you about what the purchase costs are involved with buying a house in New South Wales. Today I've used an example of some clients of mine. They are first home buyers. They've saved a deposit of $65,000, which is a great effort, and are looking to buy their first home on the north coast of New South Wales. This purchase cost estimator that I'm showing you now is what I use with my clients to explain what the costs involved are with buying a property. Their budget was $450,000 to $500,000, so I've included a price range either side from $400,000 to $550,000 just so we cover all our bases. You can see here we've got the information that they're in New South Wales, first home buyers, and they're buying the property to live in themselves. As they're first home buyers, there is no stamp duty payable on their property, even if it's an established property. Under the current regulation, stamp duty exemption applies in New South Wales for a first home buyer on properties up to $650,000. So we're lucky there. Other costs, government charges such as mortgage registration fees. The client may or may not have to pay a loan application fee to the bank or lender depending on the type of loan that we apply for and who we use. We can get an application fee of $0 all the way up to over $1,000 depending on who we use and what type of loan we're looking at. Other costs that are involved for a purchaser is your conveyancing or your solicitor's fees. The conveyancer is required to help you from a legal perspective with the purchase of your home and can guide you through what to do when. The cost varies between conveyancers, but I've used $1,400 as an estimate. We also recommend a building and pest inspection report, which is a cost of about $400. Again, that varies depending on where you are and who you use. So for these clients, the purchase costs for them to get into their property are $2,916, of which we add to the loan. So if I look down, we've got a purchase price of scenario 1 of $400,000, less the client's deposit of $65,000, plus the purchase costs, gives us the loan amount that this client would require to buy a property worth $400,000. Now you can see as the purchase price of the property goes up, so does the loan amount that is required by the client. Next, we look at what's called the loan to value ratio. So the loan to value ratio is this percentage here, and it is calculated by dividing this number here, the base loan amount, by the purchase price of the property. If this is over 80%, my clients need to pay to the bank or the lender something called lender's mortgage insurance. This insurance is an added cost by the bank to protect themselves due to the higher lending ratio. If this was 80% or below, this wouldn't be payable. Mortgage insurance is a once-off cost added to the loan and paid off over the term. Once we add the mortgage insurance, we get the final loan amount. This final loan amount is what we can apply for on behalf of the client, either as a pre-approval or an unconditional approval if the clients have located a home. This breakdown of costs is something that we provide to all our clients to understand, to make sure they understand what is involved with their new home purchase. If you found this video helpful, I'd appreciate it if you could please like the video and share it. Thank you for listening.